Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Check. Hey, Happy New Year, everybody. This is David Blake with Tuesday Tech Talk. And today we're going to quickly review the last few days of the year and what's happened yesterday. We'll take a look at what kind of damage the technical condition of the market has endured. And then after that, we'll look at the different indexes, determine some support levels and maybe some resistance areas, and try to identify sectors that might be ready to lead the way higher, or might be telling us there's more downside to go here in the first of the year. Okay, if you're new to our Tuesday meetings, welcome. I usually talk about 20 or 25 minutes, and then we open it up to questions about anything we want to discuss, the individual stocks, industries, price targets, sectors, whatever you want to feel like talking about. Okay, last week everyone was ready for the Santa rally to deliver new highs, but after a quick spurt on Tuesday, stocks sold off. The Dow Jones and S&P 500 ended up the year in negative ground for the first time since worst percentage performance since 2008. Also, the Dow and the S&P 500 ended the year below both their 50 and 200-day moving averages, and NASDAQ also closed below its 50-day moving average. I think it went below 200 yesterday. I'll check in a minute here. But the market continued its pairing with crude oil prices, and as crude oil went, so went the broader market all the last couple of months of the year. Okay, so we started the new year with a 460-point opening sell-off in the Dow. As you can see, the candlestick coming down. Kind of found support right here around the 38.2% retracement from the move off of the August lows to the November high. What triggered that sell-off was a sixth straight month of weaker China manufacturing numbers. That caused concerns again for the global slowdown. And then also we had a early morning spike in crude oil after Iran and Saudi Arabia did a little bit of saber rattling. And what was interesting about yesterday was, despite that conflict over there, several years ago that would have probably spiked oil 15-20% minimum. As you saw yesterday, because of the glut in supply, that we actually ended the day slightly lower. So that just is another point. The guys are trying to catch a bottom on oil in here. I still think it's a little bit too early, and unless you're buying dips for a trade, I wouldn't be positioning myself in the oil stocks quite yet. Okay, yesterday the market had some technical damage as it took out the mid-December lows for most of the averages. We're also back to, kind of put us back at the lows to some of the early October levels that we saw. And today we had a positive opening, which has already turned south along with another dip in crude oil prices, with utilities and Dow Jones Transportation Index again underperforming. The healthcare sector has actually given us a little bit of support. We're down about 80 points right now. We'd be down much more than that. The healthcare sector is up about 0.30%, and the consumer staples are up almost 0.5%. So that's what's keeping the market from retesting the lows from yesterday, but it's still early in here. Okay, that goes into a few weeks ago. We're talking about some of the sectors here that we're going to look at, and we had mentioned how some of the defensive sectors looked good, with stocks like Raytheon, Smith & Wesson, which is up about 10% today. Another Sturm Ruger, RGR, some of these gun companies. But today, as we're talking, Obama talking about gun control acts, I wonder if I might be a little bit reluctant to go into those kind of stocks. Cause I want to see how the market reacts to his talk today. I know they had record business in the fourth quarter, especially after the Paris attacks, where people were buying a lot of guns and stuff and anticipating controls. But You might just want to hold off on jumping into those until we see give the market a day or two to sort that out. Okay, the first chart we're going to look at here is the Dow Jones. As you can see over here, we have near-term support in the 17,116 to 17,138 area. As you can see that if we're holding at 38.2%, if we break that area, that support level, we're probably going down here to the at least test the 50% retracement from that August to November move. That would probably bring into play about 16.7, where the 50% level is. I would imagine if we do pick up selling in here, I would imagine that's going to hold on this go around. But the different indicators are still negative. MACD, LT went negative again. Momentum is actually over here about the 14-day RSI. It's actually still neutral because of this sideways motion going in here. But if you look at the weekly chart, you're going to see. Not sure where this is. If you look at the weekly chart, you're starting to see some lower highs and lower lows. Okay, so some lower lows here. You also have this descending trend line that's coming up. So you're going to have to get past about 17.7 on an upside day before you're going to see any attempt at is a real rally. But I think as you see here, you have a descending trend line up here, and you also have, like I say, lower highs and lower lows. And today we have a chance of making another low. So that's bearish. Over here, you still see the long-term MACD is still in a bearish trend for the broader market. Okay, over here next we have the S&P 500 gap down yesterday. Look at support down here. It actually went down to the 1990 to the 2000 area yesterday. I think it finished about 2010 or something like that. It did bounce off the 50%, close to the 50% retracement over here before. I would imagine that's where we're going to go down and test again. That's going to bring you in around, that was in 1990. For some reason, this isn't updated. It doesn't have yesterday's move. I'm sorry about that. But we did go down here and tested the 1990 area, which is about a 50% retracement of the move from the August lows. Momentum still is negative. We're not quite oversold on the bigger move over here. And MACD is still negative. Here is the monthly chart. This shows the weekly chart. Again, you have the descending trend line coming in on the upside, and you've actually taken out, traded below the mid-December lows. So again, not a chart of strength in the S&P 500. The Nasdaq still looks a little bit better. You went below the 50-day and the 200-day yesterday. Let's see where we are here. It also came down almost to the 50% retracement level. MACD is bearish. But I want to show you one other thing down here, and this is the ADX line, which also has it's an indicator that you can watch. And not often do we get this signal, but if you can get the ADX signal line, and we'll go back to the S&P and also with the Dow, all these charts are showing that when the ADX signal line goes below both the DMI positive and negative, often when it starts to turn up, that begins whatever line the DMI is up, and in this case it's the red line, which is negative. That's usually a good place where you can actually try to short the market. In this case, you actually the DMI, the ADX is below those two, the DMIs, and it has started to turn up. And generally, that's going to give you a fairly good short-term trade on these markets. So that's something you may want to watch. It's also telling me that we're going to get a little bit more downside. I don't think it's going to be a heck of a lot of downside, but that's telling you that we still have another week or so of market weakness, I think, going in here. Here's the Nasdaq. Again, you're kind of in the sideways pattern, but the different indicators are neutral to lower. Look at the weekly chart, and again, you still have, even on this, you still have lower highs and lower lows, which tells me you're probably going to continue to go a little bit lower on this one also. Okay, if you listen, if you tune in, we're always talking about the Dow Jones Transportation Index. Today we're down another 43 points, 73.09, another 52-week low. that's just not a sign of strength of the broader market. Transports need to be letting you know that companies are moving product, and this just again, as long as the Dow Jones transports keep going lower, it's going to cap the upside to the broader market. Especially if you're a Dow theory analyst, you have to have the transports pushing to new highs along with the Dow to be any kind of bullish trend, and we don't have that at all. In fact, I imagine the Dow Jones transport could end up later in the year, if it doesn't now, pull the broader market down to that 15-20% correction level at some point. Here's the Russell here's the weekly on the transports also. Again, as you can see, just not even getting it a bounce. And here's the 200-week moving average, which it's probably going to come down at least, maybe try to find support at that level. The longer-term MACDs are negative. Again, not a sign of strength. You are oversold here on this 30-day stochastic oscillator, but stocks can stay, or indexes can stay overbought for quite a while. Another thing that I don't like is the Russell 2000. Generally, historically anyway, when you have the January effect, you get a rally in the small cap stocks. They usually will start the year out pretty strong. That's just the opposite. They're underperforming. I think they're down about 4 or 5% here over the last month. So again, another sign that we probably are going to continue lower, at least over the near term here. And I think I'm not sure over here with the ADX if you got a line there, but again, that's a sign that's of weakness. And here we are with the weekly chart on the Russell 2000, and you're almost back to the September lows. That would be a definite negative if we break that out. You do have the 200-week moving average coming in here around 1055. That probably would be the near-term target on that. Okay, I want to check, just touch base real quickly on some of the sectors that may outperform here going forward, and the ones you might want to stay away from as we get started the new year. I don't want to sound doom and gloom on this, but because the purpose is actually try to help you find some areas that, especially if we're in a downtrend, you may want to go into as far as being in a defensive position, and just areas you want to avoid because they probably have more downside to go. But the market posture, if you read the weekly market letter, is bearish currently. We have the CTI that we're working again. We're looking probably for a bearish for the bearish cycle this time to probably extend at least another week or so, and then we actually go bullish for a little bit. But the market posture is bearish at this point, and until that flips, I would still be cautious. Okay, here's the materials sector. Not a strong looking chart. You had this bounce in oil, which gave it a nice boost after it was being oversold over here. Your gap down here found support at the 50% retracement level off of this move from end of September up into November. If we break below that, and it looks today we're at 42.46, so we're still struggling to hold that 50% retracement level. To break below that could send the materials down here to the 41.40 area, which again a negative sign for that. Probably not the best place to be looking to buy stocks at this point. Here's the energy sector. It was the worst sector last year. It was off, I believe, about 23.8% for the year. Again, when you saw yesterday's action with the tension in the Mideast, the fact that oil couldn't rally on that is really a bad signal as far as what you're going to see. I still think at some point what you might see in the energy sector after another big supply number could be a capitulation bottom where you see this oil take out about the 32.50 area. If that would happen, you could get a spike down into the $28 region. I would be a buyer of that, and I would at least trade out of maybe half of that position and see what happens from there. But there's a good possibility that we could see a capitulation low coming up pretty soon, and I would have a list of stocks which we can go over possibly next week. Stocks that you might want to buy if we have a breakdown in that sector. Okay, here's the industrial sector. I haven't liked this for a while. The reason being, again, because a lot of the big industrials have exposure, currency exposure, and unless you're buying some of the industrials that have more of their sales and revenues domestically, I would kind of hesitate on that. Again, the momentum is neutral on that, but the MACD is still looking at a bearish trend, so I would be cautious on this sector. Okay, here's the tech sector. I still like this. You had the drop-off yesterday, and you're down a little bit today, around to the 42 level. But this sector is outperforming. If you are looking to buy stocks, I would be cautious on the FANG stocks, basically because those are the stocks that have really kind of held this market up throughout 2015. They led the spike off of the September and August lows, and once people start to sell those, this market could go down quickly. So I wouldn't be chasing them in here. If I did already have them, had big profits in them, you might consider buying some protection, or at least maybe selling some in-the-money covered calls, just to figure that they're probably going to go down a little bit in here. Most of those stocks are overextended. And when you have a weak market like this with little participation, you want to back off some of that. You don't want to be chasing stocks in that. So with the FANG stocks, again, you have seen some profit taking over the last couple weeks, which again makes us cautious. Over here, next one we're going to look at the consumer staples. That one is another one I like. If you're looking for stocks to buy in there. Certainly stocks like that are defensive, like Procter & Gamble, that will pay you a good dividend. Others in that sector, Colgate, Palmolive. We could go into our industry group, look under some of the different industry groups that are involved in that consumer staples area. You can find some good stocks to look at that. That'll be another one that we'll look at next week to find some other stocks in there. Like some of the beverage stocks still look strong. Cigarettes look strong, whether you like it, if you want to invest in that. So those are some of the areas that you can to look at if you do want to start looking to go long in here over the next week or two. Healthcare is another one that I like. You are struggling over with the up here to get across the 50-day moving average. It broke the 200-day moving average. It broke below the 50-day yesterday. Even with the big sell-off late in the year with biotechs and healthcare stocks, this was still the second best sector last year. It was up about 5.3%. It's so far, as you can see over in here, we're holding the 50% retracement level off of this. And again, remember we talked about some of this sell-off. A lot of these ETFs, it was hard to find. They didn't have a bid, so they took them down way lower than what they should. So it's hard to tell exactly where these things would have bottomed out. So I'm taking this and moving it down a little bit to find that 50% level, and also measuring that back here to see where it's come down and found support before. So that sector is up today. That is another spot where I would look. It's a defensive sector that I would look to maybe buy some stocks here over the next couple weeks if you want to go in. Okay. Lastly, we have the consumer discretionary sector. This was the best performer last year. It actually was up. It was up about 8.3%, and a lot of this movement again was stocks like Ulta Salons, Home Depot, Lowe's. There were pockets of strength. This wasn't a broad-based everything goes up in this sector. I would not be chasing the Home Depots and Ultas and the Family Dollar, some of those stocks like that. I wouldn't be chasing them in here. In fact, if I owned them, again, I might consider maybe not necessarily lightening up the load, but they are overextended, and you're probably going to see some downside in those stocks. Maybe you buy some put protection or sell some covered calls just to pick up a little bit of premium while the market kind of digests what's it's going to do over here. Thing. All right. So what's ahead as we head out into January? If you've been reading the daily comment, this pairing with the market with oil it should probably continue. That's as long as unless we start to see some bombs drop in the Middle East or something like that. I don't know why we would see a rally in that. But like I said, I believe we'll probably have another week or so of some sideways to down action in here. I don't think we're going to see a 15, 20% drop in the market right here. We're down 96 today, 17,052. Again, I think the downside would probably would stall out down around 16.7, 16.8 to the downside. If we can see the transports turn around in here, catch a bottom down here at around the 7,300 level, maybe 7,250, that would also indicate that the selling is over. So keep an eye on that. Let's see here. Yes, let's say over the next week or two, I think this will kind of work its way out, and we could start to see a rally going into February and into March a little bit. So at that point, we're going to turn things over here right now with some of the questions. I have quite a few coming in, so let me get this closed down so I can pull up the charts. I close this down here. Okay, let me close this out. And, okay, oops. Okay, there we go. Let me write these questions down real quick. What are the probabilities that a bear market began last August? I don't think we're in a bear market quite yet. I think that if anything, I don't see a lot of upside in 2016. And part of that is just I think the economy is slowing. Some of these manufacturing numbers in our world are pretty bad. I know you're showing a contraction in manufacturing in the PMI the last couple of times they've had it. If we come down here to this level and if we would have some intensified selling, we get down here and you break below this, of course, then we are in trouble. But I don't see that right now, and part of that is also because of the yield spreads. I think aren't telling us that we're going into a recession yet. So I don't think that's it. But I don't expect a lot of upside or break out the new highs anytime soon. How long do you think this defensive stance will last into 2016? Like I said, I think what we're experiencing right now will probably resolve itself over the next week or two, and then I think you could start to see stocks work their way mildly higher. Going into January and February into March, I think another red flag could come up with if they begin to start talking about another rate hike in March. That might cause any early advance to kind of stall out again. So I'd be cautious in there. What is Europe looking like? I'm not real big on Europe. I just don't see it going anywhere fast, just like our market. I wouldn't be 100% invested in our market or over there. We talk about every week that you still want to, if you go into our ETF center, you can find some of the smaller companies like Belgium and things like that are outperforming some of the broader European markets. So you might nibble away at some of those smaller markets that may not be actually in a recession. But if you go into the ETF center, you can find that. We can actually look at that later on. Okay, could you please go over the best way to interpret ADX once more? Okay. All right, here's the Dow Jones. I'm going to pull up the, let me get rid of a couple of these so you can see it better. Okay. So the ADX, the DMI, when it's rising, that's the blue line, it tells you that the market is trending. Now, it doesn't tell you whether it's trending up or down. It just tells you the market's trending. See over here, you can see this thing going up when the market was coming down. We're in a definite downtrend. And as the trend begins to strengthen, the blue line, the ADX line, will continue to start to rise. Now, once in a while, when you see this thing, the blue line go down below both the positive and negative line, and then it begins to go up. Whatever line is starting to head up, that usually will give you a good trade over the short term. When it's below and it starts to tick up above the green, you want to see this go up one more time above the green, and once it gets above that, then you can follow follow the trend lower at this case, And then if you're in there for the short-term trade, as soon as you see the signal line tick down, then you can go ahead and take your short-term profit on that. And that's historically, that's given you a fairly good trade. You can see back here we went below both of them. When it started to turn up, when the green line came up, boom, you got over here. You had a little bit of a stall right there. You could have taken a quick profit, which was good. And then it started to back up, so you could have got back in over here. But that was a nice move from 16,000 to about 17,000. That gave you a short-term trade of about 1,000 points. That was nothing bad on here. Over here, you can see that it started to do something, but it really didn't. It didn't do much of anything. And back here, you haven't had that the rest of most of the last 6 months or so. But you did get a nice signal in here that I think you can probably get a trade to the downside. But when the blue line downticks, that's your first sign that you at least want to. It may be over for a little bit as far as the quick pop. See any questions else coming in here? It's 25 minutes. I had another. Somebody wanted me to talk about MEOH. Because of Methanex core. Okay. First off, you're in the materials sector, which I don't like, which is also very weak. Okay. The stock's also making a new low. It's down today. It was down about 90 cents earlier. Let me see. So you're down 3.5% today. You're down $1.20. Quite frankly, this stock breaks below this $31 level over here, down in here. It's right on it right now. I don't know how low it could go. So far buying's come in over here at the $32 range. So if it, whether you're going to make a double or triple bottom over here, it's possible. But I don't want to be in this thing if it breaks below this $31.50, $31 range, because with the oil and natural gas and stuff still weak. You don't want to do it. Now you did have some nice buying coming in down here on this run up here. At this previous level. This time when it got down there, you didn't really have much of a uptick in the buying that moved up there. It was actually kind of flat. I imagine with the volume today and stuff, you'll probably see this thing starting to go down. So the people started selling it over here. This was up on that oil and gas rally that we had in October, which lifted the whole market up. But now you've rolled over, and they're pretty much selling it over here. So I'd be real cautious on that. It does pay a nice dividend, but you're trying to catch a falling knife, and in a weak market, I don't think that's what you want to do. Okay, I'll see if there's any more questions here. Otherwise, we'll wrap it up. Okay, I guess that's going to be it. Okay, next week what we'll try to do is we'll look at individual stocks in the healthcare sector, the technology sector, and the consumer staples sector, because I think that's where you want to go over the next couple of weeks if we start to, as the market starts to pick up a little bit. And if you have some stocks that you'd like me to look at, send them in like maybe Thursday or Friday to the doc at marketedge.com. That way I'll have a couple stocks prepared to go. So with that, I guess we'll wrap it up, and I'll see you next Tuesday. Thanks for joining me.